I would offer to you that as you consider these things, that you think about the impact on not just a down economy, but on a recovering economy. And Mr. Chair, I think I can close my comments with that and be ready for any questions.
All right, members, any questions or comments? Yes, Mr. Gatto.
So thank you to all of you for coming here and participating in the hearing. I know it's probably never nice to undergo a legislative hearing on your industry. Some of the questions we might ask might be a little probing, and I appreciate you sort of opening up your books to talk with us and reveal stuff like your ROI and stuff. I was curious, what are some of the costs that go into your loans? I mean, what are some of the things that go into the cost of these products?
Well, the biggest one is the most surprising one is actually marketing. Most people don't know about our product. Most people don't understand what a product is. So a big percentage is actually just marketing the product. Underwriting, literally the originations department, the originator, the operator, it's being able to get somebody to meet the customer to close the loan. The other thing that I forgot to mention, but you just reminded me of, is that most traditional lenders are open, they call them the banker's hours. We don't have banker's hours. We have somebody at our office at 7 a.m. and typically somebody's at our office until 8 or 9 o'clock at night every single day. We're open Saturdays and Sundays. If a person cannot come to us, we will go to them. We will find a way to get them the money. And that's a big convenience factor. Obviously, that's a big overhead. So you can also look at it like kind of like a 7-Eleven of financial institutions, where it is a big thing of convenience. If somebody wants to come and borrow money at 9 o'clock at night, we'll do it. If somebody wants to borrow money on Sunday at 5 o'clock, we'll find a way to do it. Try doing that with a bank with a FICO score of 544, and you're not going to have it.
I know.
Follow up.
Thank you, Mr. Gatto.
Okay, we'll do a follow up.
And I'll be real brief
and then
about
we'll
that because
and then I have a question.
He laid it out really well. I have before me, and because this is proprietary information, I'd prefer not to hand it out, but I'll give you a sense of what those costs are. Our number one cost is cost of capital, but right behind that is personnel. The people that man the offices that Oscar was talking about at 7 a.m. and going till 7 or 8 p.m. We have an average of 4 employees per store. So the salaries, wages, benefits, all of the things for those employees is our second highest cost. Our third highest cost is rent for the location, rent for the store. Then we have advertising, inventory, office supplies, being able to operate that store. Those are all the various costs that go into a specific store location that are the costs of making those loans.
So the credit risk, is that built in your cost of capital, or is it also built in as the risk of someone defaulting down the line? Because at some point, I mean, if someone defaults, you take a loss.
Yeah, it's a combination of both. You have to, it's built into the cost of capital. That's our cost. But then what we have to factor in is the possibility, in fact, that there might be a default, that we might, God forbid, end up having to go into a repossession. That's not something we like because we lose money there.
So that was going to be my follow-up question. Do you like repossession cars? I mean, is it something... serious question.
Can I answer that?
Yeah.
Paul, can I go back and answer the last
Before we
question
do
really
that,
quickly?
I wanted to just, if Mr. Lang is finished, I'd like to give Mr. Calderon a chance to ask a question. And then I believe Mr. Vice Chair had a comment in the interest of time, if you will.
You want me to ask my question, or
Are you finished with your question, or did you?
I had just 2 follow-ups that I had.
Okay, why don't we finish your follow-ups, and then we'll go to Mr. Calderon and Mr. Vice Chair. So
my first follow-up was, I'd like to know about the repossession issue or the costs involved in that, and then I also wanted to learn a little bit about the credit risk. If someone has a FICO of, let's say, under 600 versus someone who's above 600, what percentage higher risk of default is there? What percentage? What are the odds, for lack of a better word, that person? So just go ahead. Whichever one.
May I answer? The first thing on the repossession, there is no financial incentive for a finance company to repossess a vehicle, period. It's a big it's a loss. Finance company makes money on interest income. So the longer the consumer stays on the books, the more the finance company makes. So when a vehicle is repossessed, finance company will do everything to get that person back into a car. That's just good financial sense, and it ends up being a win-win situation. So that's the repo answer. May I answer the second question about risk? Going back to the first question, which is what does what does everything, all the costs comprise of? It actually comprises of three things. It's the risk-based pricing, which is a pretty standard finance rule, risk-based pricing. The risk dictates the price. So the risk dictates the rate. Second one is cost-based pricing. The cost dictates the price. If it's going to cost me $1 to make this pen, then I need to charge more than $1. With a person that has subprime credit, it is a labor-intensive process to get that person. Well, number one is to originate the loan. Number two is to service the loan. It's speaking to the customer, trying to counsel them, try to encourage them to make a payment. So it's the risk, the cost, and then, as he was saying, is our cost of funds. Our cost of funds is very expensive because our portfolio is risky. So when you take those three things together, the cost-based pricing, risk-based pricing, and then our cost of funds is how you, you come into a higher interest rate or a higher rate.
Okay, thank you, Mr. Gatto. And then we're going to go to Mr. Calderon, and then let's wrap up with Mr. Vice Chair.
I'll throw the question out maybe to the industry. What's your default rate?
It depends on the finance company, depends on the underwriting. It varies. Some people are down in the teens, some people are up in the 40, 50%.
Well, what is your average default rate?
Have
you done that?
Fairly, the answer is no. I have not done that.
Mr. Lang?
Since I'm answering for a particular company, it's probably easier for me to say that. Our average repossession rate on an annual basis varies from 6 to 7%. Our average default rate is in the 12% range.
All right. What do you have to do to? I'm sorry, I came here late. Just what do you have to do to get a loan? If I come in there and I bring in my jalopy and I can show you I own it outright, is that all I need to do?
May I answer the question?
Yeah, for the record, he doesn't have a jalopy.
Well,
anyway, go ahead.
For the record, you don't have to have the title.
I used to.
Well, for the record, you don't have to have the title. You just have to have equity in the vehicle is number one.
Could be a second.
Well, no, we would pay off the first. So you just have to have equity, period. Number one, you have to have the ability to pay, not a flight risk, and you have to have, on your credit, you have to, looking at a credit is like a snapshot, but it also shows a history. So we look at the history today, we look at the credit in the past, and it tells, if you look at the whole thing, it'll tell you a story. Is this person, Mr. Calderon, a honest, hardworking person that worked in construction and hurt himself, which caused his credit to go bad? If that's the person, then that's somebody I want to give credit to because I know that it shows character about the person. If it's somebody that's just doesn't pay anyone, I'm not going to give them any money. It doesn't matter what the rate is because I know that they're not going to pay me back.
They have to have a job.
The ability to, no, not a job, the ability to pay.
Okay, so ability, what does that mean?
Well, it could be anything. It could be any type of income.
Just proof of income, regular checks coming in.
Trust.
Right.
Spousal support. Actually, it's true.
Mm-hmm. Social Security.
Social Security. Yep.
Okay, Ms. Torres, did you say you had a follow-up on this point?
Yeah. Because we're talking about the cost of doing business. So 6 to 7% of your company, the vehicles are repossessed. Can you talk a little bit about that process? Obviously, you make 3 or 4 calls or whatever many calls. You're late on your payment. Is there a reason? Can we accommodate you? I'm not sure what that is. Then you ultimately opt to repossess the car. So now you're impounding, you're paying impounding fees. What's happening with the car? Because cars don't sell overnight.
Right. Now, the way that works, and I'll go through a quick process here. First of all, our interest is in trying to work with the borrower if the borrower, in fact, finds that they cannot make the payments that we had agreed to in the contract for the loan. And we'll make a variety of efforts to do that. Oftentimes, people will come in physically to make the payments. We want our employees to know these people on a first-name basis. We want them to have a positive experience, not a negative experience. But in those cases where there is potentially a payments that aren't made, we will follow up, we'll make phone calls. Hopefully we'll be in touch with that person and they'll tell us what the circumstances are. It's our only very much the last resort to repossess those vehicles. And the reason is sort of exactly what you were laying out. Once we start the repossession process, we repossess the car, there's a 30-day waiting period where that car's in storage. We're paying that, right? We have to pay that. We have to pay the tow fee. We have to pay the repossession fee.
Does that look like, I'm familiar with police impounds, so it would look
some of the similar contractors that
Okay.
we would go to.
Mr. Lang, just to clarify though, the impound costs, do you not pass that on to the borrower?
If we pass it on to the borrower, if in fact, if the borrower come back to us and makes good on the note, in fact starts making the payments again, we're able to pass that cost on. If we're in a case generally where we're repossessing a car, that's not going to happen. So those costs have to come out of the auction price that we receive for that vehicle. Oftentimes that auction price will not recover, clearly won't recover the amount of the loan, but likely won't recover the costs of the repossession and the storage. So as a result, we really don't like to repossess because we lose money on every car that we repossess.
Mr. Chair, if I may, one more point. It's important also to remember that if, unfortunately, we do have to sell the car at auction, we don't get a windfall. California law specifically states that the surplus goes back to the customer. So I think that's important to note as well.
I'm going to ask Mr. Vice Chair if you want to have the last word on this.
Thank you, Mr. Chair. I'll make it very quick. I see some of their policies is no different than commercial banks who, if you're looking for an equity loan or borrow against your equipment, the lower your score, the higher the rate, but there's some differences up there. My question is, even though you're not taking deposits, you're loaning out money, but are you still required to have any insurance? And or do you require those who borrow money from you to have a different insurance on their vehicle, understanding that those are moving targets, they can be wrecked the next hour? Then the question about impounding cars and then selling it, unlike your house or anything else, the values go down, so there's probably a loss there to be taken as well. Mm-hmm. So I don't see money to be made, and the only reason you're possessing a car because they're back on payment, so there's a loss there too. I'm looking at it that your cost is high simply because your risk is. I don't know why anybody want to be in that business, but that's your business. So can you respond to the insurance part? Yeah.
May I respond? We, as our own kind of Colonel's secret recipe, we do require insurance at the time of origination. However, about 70% of our customers will have their insurance lapse or canceled. 70%. So I don't know if it's within 3 months, 4 months, 5 months, but 70% of the people, after they get the loan, their insurance cancels, which means there's no net. We're out on our own. Now we do have the right to force place insurance, but when you have a customer that is barely making the payment, just they're walking on the wire, if I went out and force place insurance on every one of my customers and added $125 or $150 more a month on their payment, my losses would just go through the roof. So it doesn't make any sense to force place insurance. And because of it, we have 70% of our customers that do not have insurance, which means our risk is obviously much higher.
I just want to wrap up here. Maybe I just had a closing comment. Oh, go ahead.
I'm sorry for interrupting you, sir, but if I may just do a follow-up with your permission. In a case where their insurance has elapsed and they get into an accident, unfortunately somebody loses their life, are you as the loaner, are they able to come after you? Is there any risk in that matter?
May I answer? The answer is that that does happen. And the way that the law currently is written is that we take the loss. And obviously we try to work with the customer to get them to pay, but you know, that involves.
Was that
small
your
claims.
question on the personal injury part of it, or?
I didn't want
just,
to, because
okay.
of timing, I didn't
All
want
right,
to go into
sure.
details, but I can get that later.
All right, I too had a, and
Yes, but you're right, it's personal injury that if they're able to come after them, but they probably have enough
I don't think they
coverage.
would. On the consumer loan statistics, Mr. Lang, this doesn't disaggregate out the car title loans. Can you give me an idea of, say, between 05 and 2010 of what proportion that was? Are you saying that the number of the principal as well as the amount of the car title loans has gone down in this proportion, say, to about a half?
No, actually, Mr. Chairman, my reason for pointing out these statistics are we talk about the tightening of credit as if on a national level and an international level, quite frankly. I wanted to be able to help the committee visualize that here in the state of California, it's really happening. And the numbers I was pointing to are exactly that. The number of loans made is about half of what it was in the last time that California was experiencing an upturn in the economy. That's
Is that for car title loans?
no, this is for all loans, period.
Well, what about, and I'm asking about car
I
title
know you're
loans.
asking
What's
for
the
title loans,
percentage
period.
that
I
it's,
don't know the
because that's what
percentage.
the hearing that we're going to have next on the bill is about, which is that proportion of the car title principal as well as amount of loans. If you could get back to me on
I'll
that.
get back to you on that.
Right.
I was using this to demonstrate the tightening of credit overall, but I can try
Okay.
to get that to you right away.
Absolutely. Okay, well, listen, I'd like to thank the panelists. Very informative, a lot of questions, as you know. We'll have a chance to discuss some specifics when we come back later on to talk about the specific bill in chief. Thank you very much.
Thank you, Mr. Chair.
Thank you.
At this time, we'd like to welcome to the panel consumer concerns related to products offered by CFL licensees. We are going to welcome no stranger to this room, Mr. Paul Leonard, the California Director of the California Center for Responsible Lending, and Andrea Luqueta, the policy advocate on behalf of the California Reinvestment Coalition. Apologize for the length of time it took to get to you, but welcome to the committee.
Do you want to go? Yeah.
Sure, I'll go first, thanks. First of all, I just want to thank you for the invitation to come up here. This is my first time testifying before this committee, so I'm glad to be here, and I really appreciate the strong interest. The California Reinvestment Coalition is a coalition of about 300 organizations throughout California. We have members everywhere you can possibly imagine in California: rural, urban, coastal, inland, representing every size, community, every ethnicity. As a coalition, we advocate for safe and affordable bank products that promote financial health and against predatory products that erode financial health. Our work has never been more necessary than during this very prolonged and painful economic downturn. The truth is that the combined cost of just basic cost of living, rent, utilities, childcare, education, combined with scarcity of jobs and low wages, it just leaves very limited leftover money to be saved for emergencies. So in light of jobs being scarce and the budgets for public assistance dwindling, many people turn to the credit markets to be able to stretch their dollar. This is not a strategy just that poor people use. Middle, upper income, we all turn to the credit markets. Credit cards, home equity loans, anything that you can borrow to help your current dollar stretch longer. However, middle and upper income households have the ability of more reliable, higher incomes that they can proactively, affirmatively use these credit markets in order to, put off some payments, pay in principal, pay on interest. There's some margin to float with, to kind of play a little bit of the shell game that we all kind of know that we all play with our finances, sometimes with better luck than others. However, households that banks, credit unions, and credit card companies don't lend to have the same need for credit, but fewer options. And we know that when a very basic product like credit is in high demand, like milk, law and regulation are necessary to protect those who need that product from exploitation. For that reason, there are significant protections in place to make sure that Californians can buy nutritious, safe, high-quality milk without having to sacrifice other basic needs. The same should be true for credit. Turning to the CFL specifically, one protection that seems to be working is the cap on interest rates for small dollar loans, those under $2,500. Currently, licensed lenders can charge up to 12 to 30% APR on loans up to $2,500. The rate cap loans seem profitable enough that licensed lenders made more than 147,000 of these small dollar loans at less than 30% APR. Some lenders made $2,500 loans at a higher interest rate than 30% APR, and I would encourage you to investigate to make sure that those lenders are complying with the rate cap under the CFL. Still, the data shows us that the best-selling loan is the small dollar rate capped loan. I've taken the liberty of graphing some of the statistics that were given in your policy briefing for the 2010 numbers. So this doesn't do anything other than just put this in kind of a visual perspective. So these are all of the loans made in 2010 for under $2,500, and the highest selling loans are down here in the lower interest rate. The fact that these are the highest best-selling loans is not a result of the rate cap. The CFL does not obligate lenders to make small dollar loans at all, only that they charge less than 30% APR when they do. Lenders are free to exclusively lend at a higher than 30% APR, as long as the minimum loan size is more than $2,500. But if they had done so last year, they would have lost 63% of their customers. I just want to point out to you that lenders made over 203,000 small dollar loans at the lower, under the rate cap, and 176,000 higher dollar loans also under the rate cap. The conclusion to be drawn here is that the 30% APR rate cap is not hindering lenders who make small dollar loans. But what happens to the next tier of levels, those loans over $2,500, is also very informative. Because once the rate cap is removed, the rate that lenders charge for these loans shoots up like steam freed from a pot lid. I was cooking a pot of beans last night, so I had the image in my mind. And then it settles into what appears to be some sort of market equilibrium. And I can show you that again, which is that while the best-selling loans, the most loans sold under the rate cap are the $2,500 loans under the rate cap, when you get to the next level, it tilts to the really high end of the interest rate cap.
Do we have that chart? It's very difficult for me to see.
I'll pass it around when I'm...
If you do it now, it would be
Sure.
helpful since you can refer to it. I'm
Yeah.
a sergeant to it.
Okay. Yeah, there's only one copy, I'm sorry. I can actually have copies of my testimony, which I can hand out as well.
I'm going to be here longer enough.
Probably make copies if there's some way we can maybe try to.
Yeah. Are we going to be here long enough? Before the meeting.
Does a chicken have lips?
I do have copies of my testimony written. It doesn't include the charts, but it has the facts.
The thing is that it's hard to follow your.
Yeah,
It's hard to follow without having a chart to.
yeah. I apologize for that. Well, maybe I can illustrate it this way. At the lower end, the size of the loan, the pendulum swings towards the side of the lower APR. So that's the highest selling product. Those are the loans that sell more than any other small dollar loan at the higher APR. Those loans don't sell as well. But when you get to the next tier, the $2,500 to $4,999 loans, the pendulum swings way back the other way, which is to the really high interest rate, above 30%. In fact, a lot of them over 100%. And fewer are sold at the lower APR. And the reason why this is very interesting is because when you get to the final tier, those above $5,000, sorry? No, sorry. When you get to the final tier, can you pass this, or did she go somewhere? Okay. Well, why don't you just hold on to this one? Yeah. This is just the last chart, which means, which is basically showing that after the pendulum has swung one way, towards the low end of the spectrum, back around to the other way, to the high end of the rate spectrum, it settles out. And where does it settle out? It settles out for those borrowers who borrow more than $5,000. That can be explained very simply. It takes very basic economic analysis, right? A seller sells a product for as much as he can sell it for until buyers start walking away. Borrowers at the $5,000 level or more seem to be able to do that. They seem to be able to negotiate terms such that the bulk of their loans are in fact at a not only lower than 30% APR, sometimes there's a significant portion of them that are under 15% APR. These are the same credit risk. They are turning to CFL lenders. They're not turning to banks. They're not banking at Capital One. They're not, right? They're going to the same lenders and yet being charged much less, with as much or more security, collateral, that is, than the other loans. In fact, the small dollar loans, the highest selling product is the low interest rate loan, and those are largely unsecured, as we were told earlier. But as you get higher into higher amounts, you have more security. And when folks are able to negotiate and walk to a different seller of a loan, they end up being charged less in the APR. So what's my point? My point is that while some borrowers are able to exert market pressure to have downward price pressure on their product that they can, because they can access other sources, it seems that there's still a lot of protection needed for those borrowers who do need credit, who are able to provide some collateral, but because they are being pushed into $2,600 beyond the rate cap, end up being gouged and paying more for the same product for no other reason than because they can be. They need the money. They're a captive market. Just like a growing family needs milk and needs protection to be able to afford high quality milk without sacrificing other basic needs, so do credit borrowers, whether they're at the $2,500 or $5,000 level. Thank you.
I believe Ms. Torres. Okay. Any comments on this? Yes, Ms. Harkey?
Could it be that the larger borrowers who seem to get the lower rates is because there's probably a fixed cost to making a loan? And if you have more money, if you're borrowing more, it doesn't cost any more to process a larger loan, but yet the institution, the person, whatever, would make more money per loan if the loans are larger. Because there's a fixed cost to processing the paper, to inspecting, to collecting, to all this, and it's all, and the office space.
It's logical to believe that there are some fixed costs, right? Like the cost of personnel doesn't change from loan size to loan size. However, the risk, which is what we've been hearing about it, the risk of a loan going bad for a $10,000 borrower that has security, I would think requires a little more effort to make sure that that loan doesn't go bad than the, say, $4,000 loan that has security. If that loan goes bad, that's much less of a hit to the lender. But if the $10,000 loan goes bad, that's a bigger hit. So I would say that actually, there would be more risk, more reason to dig deeper, more reason to ensure, and therefore, according to the testimony we heard earlier, higher cost of doing business that would push the interest rate up. Now, mind you, the cost of capital doesn't change from the small dollar loan to the mid-level loan to the higher size loan. So that doesn't explain the drastic price fluctuations. And probably risk may, but certainly not 3.5 times the risk for a $5,000 loan than for a $2,500 loans, or certainly not what we end up seeing in the higher market, not so much less of a risk for a $10,000 loan than for a $5,000 loan.
Probably the scrutiny would be more and the ability to repay would be more, but I still think you've got a fixed cost of lending that is going to be considerably less the more dollars that are out. I mean, that's standard banking practice. I mean, you loan more, you earn more in a smaller percentage. So I would think that has to be calculated into it. As for unsecured, secured, collecting collateral, there's loan loss reserves. I'm sure they have to calculate into to their formula to stay alive.
And in fact, the under Dodd-Frank, there was authority given to create a loan pool to lower the cost of capital for CDFIs to make small dollar loans. So I think that there are things that are happening to help the industry lower the cost, standardize risk, and so forth. But it still 3.5 times the APR for a particular type of loan that can't be explained to the other sizes of loans. It begs the question.
I'll let it go, but I beg the question: if you were to diminish that, would those loans be available? So.
Yeah. If you please excuse me, what we're going to do is I've been given notice by several members that they have to absolutely leave in a little while before we need to get the vote. So this is what I'd like to do. I'd like to get into Mr. Leonard's comment, and we'd like to wrap up the hearing no later than, and then we have another speaker, and like to wrap this up by 4 o'clock and get right into Mr. Dickinson's bill. And Mr. Calderon, can you hold on your question until Mr. Leonard maybe makes his comments? Okay, thank you. Appreciate that courtesy. Mr. Leonard.
Yes, my name is Paul Leonard, and I am the California Director of the Center for Responsible Lending. I want to commend you all for having this important hearing today. I think that hearing on the broad context of the CFL lenders law is long overdue, and certainly welcome the opportunity to comment. CRL is a national policy and research organization. We're affiliated with Self-Help, which is one of the largest national community development financial institutions. We operate credit unions in North Carolina, which is where we're based, as well as having 18 branches that we've acquired largely through mergers over the last couple of years, nearly 50,000 members, providing core basic financial retail financial services to underserved communities around in the Central Valley and in the Greater Bay Area, with looking for an opportunity to continue to expand into other parts of the state. I wanted to briefly touch on make 4 key points. First, I think it's really important to talk about the context for consumer finance lending, because I think if you listen to the conversation here today, you would think that the CFL is the only lending that's going on in the world, when in fact, in reality, it represents a very, very small part of national credit markets. And over the last 10, 15, 20, 25 years, there's been a dramatic shift away from this kind of basic retail consumer installment lending to rely overwhelmingly on credit cards. Credit cards have represented, now are the main source of consumer finance lending. The kinds of things that we used to take out a loan for furniture or for other kinds of medium ticket, hard, durable purchases are now financed through most households with credit cards. And that's because credit cards are a very efficient way of allocating credit. There were something like $6 billion offers extended for credit cards last year, and the credit card companies have figured it out. They heavily use automated underwriting and other technology to efficiently allocate credit where it's needed without a complicated or time-consuming and expensive manually underwritten application process. They work for many consumers, not all, and certainly credit cards have their problems. But by giving borrowers flexibility in terms of their repayments, credit cards have become the dominant source of consumer credit that is available and is the most valuable source of consumer credit for most households in this country. A second point I would make relatedly for context is that we are now in the process of recovering from a historic recession that has been marked by historic levels of household and consumer debt. So we're in the process here of deleveraging household debt rather than trying to think about how we encourage consumers to take on more and more unsustainable levels of debt going forward. And I would point out that we should not confuse credit as a substitute for inadequate incomes. And clearly people have economic needs that they're having a hard time meeting, but credit, and particularly high cost credit, like much of the consumer finance lending that is happening and has been discussed already today, is not necessarily the answer for replacing somebody who fundamentally has an inadequate income. Second, I wanted to talk a little bit about what I think that really the fundamental principles of responsible lending should be. Quickly, one is fair pricing, that the pricing should be related to the risk that is at hand for the lender. It should decline with the length and the amount of the loan, as Ms. Harkey mentioned earlier, the basic idea that if you can lend more money, you can generate more revenue with a lower rate than with a smaller loan, and even then a smaller loan at a higher rate. There should be transparency in all loan transactions. Borrowers should understand what they're getting into. There shouldn't be a lot of details hidden in the fine print. Borrowers shouldn't be exposed to unexpected high fees, and no spurious or unexpected add-ons should be sold with basic credit products. Third, and critically important, we believe, is that the law should provide that lenders are rigorously evaluating a borrower's ability to repay the loan. That's in the interests of the lender. It's also very much in the interest of the borrower. We've certainly seen what happens when those kinds of lending standards don't get, when they get sacrificed through the context of the subprime mortgage lending crisis. We've seen some interesting models being developed, particularly in the small dollar credit pilot program that was enacted a couple of years ago, and Ms. Owen referred to. There was established a set of benchmark standards for evaluating a borrower's ability to repay a loan. Another concept that I think is critical is that there's a net tangible benefit for a borrower, that the borrower is actually getting something out of the transaction and not simply digging themselves into a deeper and deeper hole. And finally, there should need to be reasonable security and collection safeguards, that people shouldn't be hounded, that the process for collecting on secured collateral should be transparent and clear, and collections process also, consumers deserve fair collection processes.
Okay, we have two questions. Assemblymember Calderon, and Assemblymember Gatto will be next.
All right, I'm not going to ask you a bunch of questions to state the obvious, so I'm just going to state it. You don't have to agree with it. But in terms of a captive audience, I mean, captive market, why are they a captive market? They're a captive market because they can't get money anywhere else, because they can't get the money to buy the milk. So, and in terms of doing some evaluation about whether or not they can buy the loan or pay for the loan over the long run, you're right. I'm glad you pointed out that's not what Wall Street was doing, and that's why we're in the mess we are. And even your 32 credit unions probably made some of those loans and probably have some of those loans they can't. So it's difficult at best to be able to evaluate credit worthiness. But here's the rub here. The rub here is, do we force those that are making these loans now to do it at what we think is a fair cost of money? Or do we force those making loans over $25,000 or over $5,000 lower their rates or their underwriting standards to make and provide loans to everyone who needs them? So there's a market here, there's capital, and there are loans being made at a rate that you think is not a fair rate. So you say, well, they need to lower their rate. Well, we can lower their rate, but why don't we also take a look at the banks and have them lower their underwriting standards and their underwriting requirements? But the reality is that's never going to happen. That's not going to happen. And I'll just finish by saying, if you take I was invited to have a credit card. I forgot what it was, but credit card. Your rate's 15%. I forgot what bank, but 15%. However, if you agree to this and you make one late payment, your rate goes from 15% to 29% if you missed one, and forever, for the life of the loan. It gets almost 100% increase. Well, it is 100% increase in the interest. And not only that, if you're late on another card with our bank, not this one, but another card with our bank, then your rate goes up on this card forever at 100%. Now, it's easy to focus on this market. It's hard. It's hard to survive. And the fact that there are so many loans that are being made in this area, I think, suggests the need for something to happen. But the reality is, you're not going to get it to happen unless you provide dollars, capital. And no one's going to provide capital if they don't think it's in their best interest to do so. So then the end result is no milk. So, that's what, I guess I want to focus on and have you react to.
Let me just clarify. I'm not opining as to what is a fair rate. I'm not suggesting what the rate should be. What I'm saying is that at the lower end, lenders are making loans at under the 30% rate. Those loans are selling like hotcakes. Sorry?
We got to hurry up and go.
Okay, sorry.
I'm going to let Assemblymember Gatto finish.
Okay, so in the interest of time, I'm going to mix some questions and comments. I'll thank both of you for coming here. I really appreciate you helping us get to the bottom of some of these issues. First, just general comment I have is, throughout history, people who have lent money have never been popular. And I think the reason why is because they have money and other people don't. So. And, so I appreciate us trying to work to get some of the facts out and some of the myths and things like that. One of the questions I have is, if this industry is so profitable, and we talked a little bit about ROI and profit margins and such, couldn't somebody just come in and undercut the rates and make a tremendous profit? Wouldn't they get all the loans? If this industry was so profitable?
I mean, I'm sorry. I have to say, I apologize that I missed the discussion of the rates when I had to go to testify at another. So I'm looking forward to sort of getting the summary of that presentation, because one of the additional points I wanted to make that I think is critically important has to go with the DOC and the data that's collected. Because in order to have really informed policy, we really need to know about default rates. We really need to know about ROI and the profitability of these institutions. And at least from the information that's publicly available, it is impossible to tell what's going on in terms of defaults and in terms of profitability for these institutions. I think there is the possibility that that would be the case, but I think we've seen it. I'm more familiar in the payday lending context than I am in the small dollar loan context. I think the small dollar loan is clearly a tough business, no question about that. But in the payday loan context, you see huge numbers of lenders, huge numbers of transactions, and virtually everybody is charging the highest rate allowed under law. So the idea that, well, yeah, in theory, someone could come in and do it, but in fact, that's not necessarily the way the markets always pan themselves out. The other thing I thought was really interesting in looking at the DOC report on this data is that the data is really bifurcated, and you see two tails. About 55% of these loans are in the above 40% category and the between 2,500 and 5,000, and then 40 to 45% of them are in the below 30%, in the 30%, which a more reasonable rate. So you see about a quarter of them are in the above 100% interest rate, and then this big category of 40 to 99, where we don't really know what's going on. Again, a shortcoming of the data.
So just two more questions, and I'll just ask them in turn, and you can answer them in turn. How much, though, when we're discussing these issues, is it somewhat, are we using inflammatory rhetoric? I mean, if I on my Sears card, I charge $1,000 this month, and then I don't pay next month, and there's a $100 late fee. I mean, some of the cost of calculating APR is just a matter of when I pay that back. I mean, if I pay it back a year, well, that $100 late fee, well, it's 10%, right? But if I pay that back within a month, to borrow that money, that $1,000 for a month, because I got charged a late fee, that's 1,200%, right? So it's just, how much, when we're analyzing all these very, very complex issues, is the discussion just a bit inflammatory? That's question one. Question two, real quick, is the cost of default, because you talked about how when we go down a bracket in terms of FICO score, the interest rate should be this percentage higher. I just think it's important to remember that when there's a default, it's not a loss of the interest payments, it's a loss of the principal. I mean, if you loan $10,000, you're not only losing the profitability that you'd get on regular interest payments, I mean, you're losing that $10,000. Right. And if there's, what I've heard the statistics, I researched this before I came in here today, just one bump in FICO score, one significant bump, like 600, 500, there's a 40% higher chance of default. So if there's 100 defaults of $10,000 and then all of a sudden you have 140 defaults of $10,000, when you go a tier down, I mean, that becomes a cost to lend. And I care about capital being available. I think everybody on this dais today cares about capital being available. So I'd just like to hear your thoughts on those questions real quick.
We definitely need more data, because you're right, the APR, we need to have a more standardized measure so that we can be sure that we are in fact comparing apples to apples. But all I did was look at the data that was reported to the committee in the briefing and just put it on a map. So as far as I know, the APRs for loans under $2,500 to the next size, I'm assuming that they're the same. They're reported as the same. What I'm questioning is that even if they are the same, there seems to be, the trends are telling us is that somehow the smaller unsecured loans are less risky, less costly to lend to, and so are loans over $10,000, that those are less risky, less costly to finance, but that somehow this tier of $2,500 to $5,000 loan amounts, that somehow justifies APRs of 3.5 times the other tiers. That's what I'm questioning. And that particular push, I'm asking, where is that pressure, that price pressure coming from? If the best-selling products are the cheaper selling products at both ends of the spectrum, why do we have this increase suddenly in the middle? And the only reason that I can explain is that there are people who need some amount of money are the first ones to enter without the rate cap, and they can be gouged because they don't have the ability to say, well, I'm going to go walk. I've got more options than you, right? So it's not about not milk. It's about, is the milk spoiled or not, right? So here we've got sellers who are selling good products on one end and good products on the other, or better, let's say. And suddenly in the middle, a spoiled product. And it makes you wonder, are these the products that they're making the money on? And if so, is that fair?
I would just also add that one point.
I'm going to ask if we could
just that one
start wrapping it up.
Absolutely, but I mean, I think especially when you look at those very high cost loans, there's basically two kinds. There's auto title loans, and then there's a company called Cash Call. High volume, high default level, high rates. Right, so they make it up. They expect to get high losses, and then they make it up. They make it up just by relentless and high advertising. Most of us have seen them on our late night TV shows. But the auto title lending, I think, is a particularly interesting case because it's secured loan, right? And whether or not the loans are, whether or not the loans are being repossessed, and I thought it was interesting here to hear the small number of repossessions that are occurring. If it's accurate, I think it indicates that the interest rates are way too high. That you know, if the loans were that risky, you would expect to see more repossessions. And so there's a disconnect there between secured loans and high rates. And as we heard, the car loans, they're discounting the value from the market value to the auction value, essentially. So they're over collateralized in terms of actual market value, and that the disparity between a secured loan with an interest rate of 150%, that's a 4-year installment loan, somebody's going to pay back $10,000 over for a $2,500 loan, just seems to me to be a signal that this is a little out of whack.
And I think maybe we can get into that a little bit more specificity when we come and take our bill. I know that some members have to leave, and we did want to make sure that we had time for the second bill. So at this point, thank you, members. Apologize that a lot of the questions started coming toward the end. Wish we could have spent another hour on this. Thank you very much, Mr. Arcana and Mr. Leonard. At this time, our final speaker will be Mr. James Gutierrez of CEO Progreso Financiero, a company that he founded in 2005 to bring microlending to the unbanked communities, made over 35,000 loans, 120 employees, 125 locations in California and Texas, and is the impetus for the pilot program that many of us were present at, the creation. So welcome to the committee. Mr. Gutierrez, sorry for the lateness of the hour. We will have to keep your comments brief, and hopefully members will have questions for you. And
okay, great.
Go ahead.
Good afternoon, Mr. Chairman, Mr. Vice Chairman, members of the committee. Thank you for the opportunity. Great to see you again and be back in Sacramento. So just by way of background, my name is James Gutierrez. Tell you a little bit about Progreso Financiero, so you understand. I grew up in Southern California, Latino community, realized that there's a lot of unbanked people who don't have access to capital, and the way we grow our communities is by providing access to capital. I believe in private sector solutions to solve public sector problems, and so I graduated from Stanford Business School in 2005. I had my own kind of Google-ish idea, which was, let's see how we can innovate in providing products to those that are underbanked and unbanked. And what we focused on was, how can we make the biggest social impact? Well, if we can help people build credit scores, then they can really improve their livelihoods and their future financial potential. We found there's a lot of hardworking people, but they just didn't have a credit score, so they couldn't get access to a good loan, couldn't get a bank account, so on and so forth. So started Progreso 2005. We've now made about 240,000 loans, all in the $250 to $2,500 range. In California alone, this past year we made 135,000 loans. 135,000 loans this past year in total. 115,000 of those were in California. We're now in California and Texas. We have about 90 locations. We're primarily in supermarkets. If you go inside Latino supermarkets, we'll have a Progreso Financiero booth there, and that's where you can find us. So most of our borrowers are $25,000 to $35,000 of income. Their reason for getting a loan is because they want to build their credit. They also have an emergency they want to fund, or sometimes it's small business or some auto-related capital expenditure that we're funding. We are, I would assume we're now one of the largest lenders under the CFL for loans below $2,500. Our biggest challenges in building the business, we've now raised over $100 million of venture capital since we started, over $200 million of credit lines. We've made over $250 million of capital available to low-income communities, and we were certified as a community development financial institution by the U.S. Treasury in 2009. Our biggest challenge has been, it's hard to make money on small loans. So frankly speaking, is profitability. We're still not profitable. We're almost there, but it's been a long road. We believe in providing a fair product to people, but providing a fair product and making money has been something that's been challenging. The other side of it is where do we get all this capital? Since we're not a bank, and we're going to lend out, we've lent out $240 million. Our plan is to lend to underbanked communities $1 billion. Where are we going to get $1 billion of capital, especially if the securitization market is not working so well? So those are our two biggest challenges. As we look at California, and the graphs that we handed out here is sort of, it says California dilemma. There's a lot of demand for small loans in California, but as you can see, the distribution, 12 million of those loans were payday loans, 200,000 of those loans were for CFL loans below 2,500. So in 2010, working with Senator Flores, we said, look, this is a dilemma in that there's not a lot of competition or price competition in the market. So if CFL lenders are only doing 200,000 loans and there's 12 million payday loans, there's not a lot of people putting pressure on pricing and trying to provide alternatives to payday. And so we felt that the reason for that is there's a problem in the law. And the CFL law was too restrictive and needed to be amended so that there could be more credit building opportunities for the underbanked. So that was sort of the impetus behind the law that was passed, the pilot program. And one other thing I wanted to let the members know is when it comes to the unbanked, there's a question earlier, I think from Assemblymember Calderon, which was banks are not lending to this community. That's right. Most of the people we lend to don't have a FICO score, or they have a FICO score of 540. So if you go to a bank and you come in with that kind of credit record, they're going to say, sorry, you're declined, better luck later. So, and that's what's happening to underserved communities, whether they're ethnically underserved or they're just low income. And California, with high unemployment right now, it's tough. So banks don't make these loans because when they go to their regulators, the regulators say, the way I measure risk is FICO, and if you're lending to somebody with a 540 FICO, I'm going to shut down the bank because it's too much risk. So therefore, banks don't do it. So it's really only the non-banks, the payday lenders and others like us and others that are actually serving this community and providing access to capital. The other thing that's happened is what Paul Leonard was talking about is that credit cards have taken over the small loan market. And to the example, again, of Assemblymember Calderon, they may send you a 15% APR offer, but that APR does not include the fees. So we have to, for example, when we quote a rate, if we say 36%, that's a 26% interest rate, and then the origination fee that's combined to include a 36% rate. Credit card companies will only tell you the rate part, and they don't combine the fee part. And so they're also able to get federal preemption, and they can bypass California law using an Arizona or North Dakota bank. So since we have to abide by California law as a non-bank, and in every state we lend and get a license in Texas and Illinois, et cetera, we're restrained by these price caps that exist in California. So now let's move to the law and the questions about the pilot program. So basically our idea here was, look, let's do a two-sided solution. Let's do something that's good for industry so we can get more competition. We want to get more innovators in the market that are going to provide a good offer to consumers. And then let's also figure out things that are good for consumers, like you have to report people's performance to the credit bureaus so they can build credit, establish credit. Like you have to do good underwriting, to what Paul Leonard had just suggested. We increased the numbers a little bit. So if you go to page 2 on this, you get a graphical interpretation of sort of the old law was on the left, And the different colors here are different terms of loans. So if you have in the blue, if you have a very short-term 3-month loan, obviously the APR is going to be a lot higher. And this is, down below you have loan sizes from 250 up to 2,500 where then the law changes. So what the pilot program did was basically change the left picture to the right picture, and those are the new APRs when you include the fees. So interest rate plus fee, those are the APR caps depending on the term of the loan and the size. So how did this impact us? As I just heard from the commissioner, I was surprised to hear that so 3 applicants for the pilot program. We thought it was a great idea. The whole idea was to get more competition in the market, increase access to capital, yet only one licensee has passed of 3 that have applied. So we were approved. I would say kudos to the DOC. They did a good job getting the program out very quickly. We applied once it was available, and we've been using the program for this year. So what's the impact on Progresso? Slide 3 here. Our average APR used to be 34%. Now it's 36%. So we got a 2% increase in pricing. That was very helpful. To take advantage of this, we increased our average loan size from $1,000 to $1,200. So that's reflected there. Overall, though, for the year, it still has a very marginal impact on our profitability. We were only able to get $1 million more of revenue as a result of this program. So at the end of the day, as we look at it now, what went well, what didn't go so well, I think, a potential failure, not failure, but an improvement opportunity is that there's only three applicants, and there's only 1 that was passed. So we need more people in the program, and I would suggest that there needs to be some amendments made. Other things is that on the pricing we would argue is actually still a little too restrictive. And keep in mind, this is payday loans is 400% APR, and look, we think access to capital is good for everybody, so we would argue that that they have a place in the market, but there should be competition. So with this restriction, even under the new pilot, it didn't go far enough, basically. And so our proposal would be that 1, it's a pilot program, it should be made more permanent or increase the life of the pilot. But we would propose to increase the cap on origination fee from $65 to $75, increase the interest rate that's from 0 to 1,000% from what's currently at 30%, increase that to 34%, and then from 1,000 to 2,500, it's currently at 26%, increase that to 28%. So we're talking about 2 to 4% increases here that are very much on the margin, but very much needed to have more people actually enter the market and provide loans. The last thing is sort of a crazy idea I'd like to share with you on how do you actually get this problem solved. So you have a lot of low-income people in California. They're not getting access to capital, at least not from banks. They need access to capital to fund a lot of their needs and really for the economy to grow, in addition to more employment. The problem is that when you're a startup, let's say like Progresso, and you're growing those loans, you need to have a lot of scale to make this business work. Because of course, Assemblywoman Harkey was saying, she was absolutely right. The cost of a loan, if I provide a $100,000 loan or a $1,000 loan, is the same cost. The cost is not proportional to the size. So if you're doing a small loan, it means your APR is going to be a lot higher to cover the dollar cost associated with that loan. And so it's very hard to make money on small loans. And as you're trying to innovate, what we would recommend is there should be some form of, you have these carbon emissions trading credits. Well, why can't you have tax credits that we could trade to companies that are profitable, and we could get money in exchange when they buy those credits from us for doing what's kind of a social good until the point that we're basically profitable as a business. So that's kind of a bigger change and a bigger idea. But the reality of the situation is that Progresso has had to face it many times in its history. So we now employ 600 people. We've grown a lot from the days when I founded the company in 2005. And we've had to face the fact that we may not be able to make it for the following month because, we're still relying on venture capital. We're still losing money. And we believe at some point we're going to turn to a positive, like Amazon, other companies that did that, and the innovation and the employment we're creating in California and in Texas. But basically, the business model of doing small loans is extremely difficult, especially under these restrictions. So frankly, there needs to be some additional changes. And at the end of the day, when a consumer sees a price of a 26% rate plus an origination fee, which is a 36% APR for a $1,000 loan. So the math is, I lend you $1,000, you pay back $1,200 over 10 months. So your dollar cost is $200. That's a pretty good trade for a lot of people that are lower income, and they also can build a credit score. And so what we want to do is proliferate the market with more of those good options, but frankly, there needs to be more changes in the pilot program to do that. So I wanted to make it brief. That's a quick summary. If there are any questions, be happy to answer them.
Okay, we'll take some very, very brief comments, and then we've got to run into the next hearing. Yes, Mr. Morrell.
I just have a quick question. Give me a couple of reasons why you haven't been profitable. Is it repossessions are high, accounts receivable? What?
Sure. So we do only unsecured loans. Yeah. So we're not doing any auto title. It's all unsecured from $250 to $2,500. So very small. They're all installment loans. So, like for example, we lend you $1,000. You have a payment every 2 weeks of $60. You have 20 of those payments. You pay back $1,200 over 10 months. So that's kind of the structure. The reasons for our cost side, the biggest cost is, especially in the underbanked market, they want high touch. So they want to be able to see someone's. People that are underbanked don't have a lot of financial education, need that relationship. So that means personnel cost and labor. And certainly the labor laws in California are not, I would say, the easiest relative to other states. And so you have a lot of you have a lot of costs associated with that. And so that's part of what we call acquisition costs, cost to bring it on a customer. It's huge.
And it will include locations too.
It will include the cost of locations, all of the people, all of the underwriting costs, but it's largely a fixed cost of people. We've innovated a lot bringing that down, but frankly, with all the innovation we've done, it's still high. We've combined technology, we're in Silicon Valley, with the high touch and tried to do that. The other cost is servicing cost, the cost to collect, and then funding cost. Since we're not profitable, we have lines of credit with B of A and Silicon Valley Bank. They've been great partners, and others. But we also have a hedge fund who's lending to us at 15%. So if we're borrowing money and we borrowed $85 million from them at 15%, you can do the math. It's very hard. Well, why are we having to borrow at 15%? Well, it's not because our credit losses are high. We're proving that this customer base is actually pre-prime. Their credit losses are equivalent to prime, so they're really good. It's because we're unprofitable. And if they're making a loan, and even though it's secured by our assets, all the loans we're making, they still deem it to be higher risk, so we have to borrow at 15%. And then finally, it's losses. But for us, losses have been in the single digits, and we've been proving that the population that we're serving are actually very credit worthy and pay very well. So for us, it's acquisition costs, servicing, and funding costs are the largest costs.
Thank you, Mr. Vice Chair. You want any closing comments on this?
And again, for my apologies for having left and due to other commitments, and I have to leave again for another commitment. Apologies to Assemblyman Dickinson if I'm not here during the time that we need to vote. But in a sentence or two, if you were to summarize this bill, how would it impact? Obviously, there's a demand that you're in business to supply the needs. And probably you're the last resort because somebody needing $50 going to a friend or a family before they're going through the process that you have in place. And I know it's not a pleasant one, not because of you, but just the idea of going through. How would it impact your business?
How would what impact?
The bill that we're going to discuss in a little while.
The title lending bill. I actually haven't reviewed it, but we don't do title lending. So
you're different lending.
So what we would propose, Mr. Vice Chair, is amendments to the pilot program bill that was passed in 2010, which was SB 1146. At the time, it was called that. That there be a new bill to amend that bill or to amend that law to make it better.
Okay. So
it wouldn't be a comment on
what we're going to discuss in the upcoming bill. That whatever happens there has no impact about your capability to loan out or the amount of rate you can charge.
We would propose that there be additional amendments to the existing pilot program, As regards to the auto title lending bill, we don't have any comments on that
No
bill.
connections. Okay, thank you. My misunderstanding.
Thank you very much. And if there are no other comments, that's an excellent way to close that. You know, this pilot program that started off, I'm not sure whether there's enough of a track record, but you could make the argument either way that without an amendment, you'll continue to see a rather low level of participation. And so it's the chicken and the egg. But we'll have that conversation. I'm sure that if there's legislation, you'll be in touch with one of the legislators. I want to thank everyone for participating today. Apologize, we have a hearing coming up, and we'll have more comments to make afterwards. If there's anyone that wants to make a comment about the hearing, we're going to postpone the public comment until after the hearing on the instant bill that we're going to be discussing right now. So at this time, we'd like to call the absent members to the Assembly Committee on Banking and Finance. That would be Mr. Calderon, Ms. Torres, Mr. Perea, Mr. Lara, Mr. Fletcher, Ms. Harkey. If you will come, and if the sergeants can also help me call the absent members. I'd like to ask Mr. Dickinson to come up, and thank you for your patience. Apologies, but we did kind of target this for around 4 o'clock, and so we're just about a few minutes off that target. And as you can tell from the previous discussion, there's a lot of interest in your bill, and a lot of interest in the concerns that were raised this afternoon. So without any further ado, if you'd like to welcome to the committee and present your bill.
Thank you, Mr. Chairman, and members. At the outset, I want to thank you, Mr. Chairman, and the committee staff for working with my staff and me over the intervening months since we last met to this new year on this, I think, important but complicated issue to be sure. And I want to compliment your staff for, I think, having provided a very good analysis of this bill for the benefit of the committee members. Let me say at the outset, there are several amendments that have been suggested by your staff, and which you and I have consulted about, and I am prepared to accept those amendments as authors of amendments as detailed in the committee analysis. Let me, in the light of the hour, try to be brief. I think you heard testimony which, while it ranged over the landscape with respect to the consumer finance lending law, certainly did provide background and information regarding auto title lending, which is what we're talking about solely with respect to AB 336, auto title lending. So let me try to make a few, hopefully, germane points about the bill and about auto title loans. These are loans which are not explicitly authorized under the law. They exist, in fact, because they're not explicitly excluded under the law. They are subject to no interest rate cap if they're above $2,500. And as this committee knows, my bill started out with an interest rate cap after listening to testimony and considering members' views. The bill's been amended to delete the interest rate cap. These loans are apparently growing at a very rapid rate. If I understood the testimony today from the Commissioner of Corporations, if we look and compare the data from 2009 to that of 2010, it appears that these types of loans, these auto title loans, have grown by about 50% in the span of 1 year. And the fact of the matter is, with these loans, the risk is virtually entirely on the borrower. The risk is entirely, virtually on the borrower, who takes the risk of losing their vehicle for which they have signed over title to the lender. The lender, on the other hand, takes virtually no risk. No risk. First of all, the lender has title to the vehicle. So they have loaned money at something which typically is between 50 and 65% of the value of the vehicle, which if they do in fact end up repossessing, they can sell the vehicle at auction, recover their principal, and recover their costs of disposal. And by the way, if they accrue costs during the course of a repossession, those costs are added on